Good evening. This is Ken Long from Tortoise Capital Management with the weekend report, strategy report for November 27th, 2010. We're going to take a look at the market health check first. We are in bull normal conditions. You can see the trendiness on the ADX reading has dropped down to 15 and almost a neutral position between the plus DI and the minus DI. So this positive strong trend throughout the last 8 weeks has weakened considerably and is now pure sideways. The horizontal red lines are various support levels we've seen in the past 3 months. The purple line is a profit target that we're using for a retest of the swing high of about 12 days ago. We have our 3 time periods: 10 days, 20 days, 30 days ago. Shaded blue area is the 200-day moving average. You can see that we're still about 8% above that. The slope of the 30-day regression line is still positive, but it has weakened considerably. This is the channel that's defined by the extreme moves away from that regression line of the past 30 days. You can see on Williams percent R10 that we were oversold a couple times, and we've had one little bounce here, but we're still in the low end of oversold. On an annual basis, we are still at the boundary of overbought long term. So this could be defined as a pullback after that long-term intermediate trend. Shifting to the strategy report now. You can see we're still bull normal. The annual RSI weekly is at 59 in the middle, 32 out of 100 on a 10-day index. Among 10-day max pain candidates, we're looking at Bank of America, JP Morgan, Cisco, Alcoa, and Home Depot. So we have 3 or 4 of our favorite targets inside here. I'm looking at weakness in the financials. On the ETF 100 for max pain, looking at regional banks, Singapore and Hong Kong, India and China. So 4 out of the 5 ETFs we'll see are in Asia less Japan. It's not surprising then that when we look at the overreaction and channeling systems, we see the Euro-Asia mix, Asia less Japan, and then emerging markets signaling on their sharp pullbacks. On the market gap stat statistics, we're still seeing about a 50% of the time the market is reversing after the gap, regardless of the direction, so there's no edge there. The standard deviation of the overnight gap is still at 0.74. You can see the intraday stats, a 2.4% move from the low or the high is still within the range of normal. You can see the path of the 10-day index here. We're still closer to oversold than we are overbought. S&P volatility, after drifting down into the quiet range, is now moving up to almost normal compared to the last 200 days. A review of the ADX and trendiness. It's been on a steady decline in the last 25 days. Quite a few symbols, high-quality symbols on the triple screen. We can see in here Yahoo, Weyerhaeuser, 551W. There's a Ford. It looks like an interesting chart pattern. And the 5-day down, we're seeing Verizon and Avon Products. Friday was a tough day. Look, JP Morgan and Bank of America are oversold on a 10-day basis, and we're the percent losers. So that possibility of a one-day washout in there. Winners in now Caterpillar, Hewlett-Packard, Intel, all in favorable positions. Natural gas and mixed commodities had a bounce on Friday. And you can see in here that Asia less Japan and emerging markets have been exceptionally weak compared to the rest of the world market model. Quite a few dojis on our Dow Tactical. A lot of channeling signals firing on pullbacks and triple screens in Microsoft and ExxonMobil. I'd be very interested in Microsoft because it's a max pain as well as a triple screen. 551W signals in trading favorites Alcoa, Disney, and Home Depot. A lot of dojis based on the low volume and narrow range on Friday. Channeling signals in the utilities, Europe, Asia blends, Asia less Japan and emerging markets, and they were also max pain range compression candidates as well. You can see the weakness in finance that was inherited from JP Morgan and Bank of America. So I think those are two that, if we're thinking about rebounds from oversold conditions, those are going to be strong themes for us next week. You can see the R-squared statistic in the regression line has really flattened out because of the volatility above and below the line. And the regression line has pulled back to the 180-day average, so that long, strong trend is clearly weakened. And you can see that here in this review of the price of the past 180 days. IBM and Johnson & Johnson dominating on the 30 to 60-day qualities. Again, what I like to look for are red and then white, or red then yellow. Disney is still looking favorable, and I still think American Express is very positive here. It went from red and then to green. And I think if there's any strength in finances on Monday, and if AXP is outperforming XLF, then that becomes a low risk trade. On the ETF report, natural gas is looking like it's bouncing. It went from red to white on 2-month versus 1-month quality. On the positive end, silver is the only thing that's been in the green for all of those. So any momentum in silver, and therefore silver Wheaton symbol SLW is worth examining. References for intraday range percentages for your trading targets, so you have an appreciation for how far they can move intraday under normal conditions. You can see that although the longer term moves were all positive, you can see how in the 5 and 10 day things are negative. The things that are standing out, though, as having resisted the pull-off, mid-caps and technology. We see that from the ETF2 report as well. No signals from the safe zone for our ETF2 positions. And that's it. That's a quick look at our strategy. So what I take from this is Monday, I'm looking for Asia less Japan, finance, and silver as my primary targets. Thanks for your attention.